Morning, Chris. How you doing?
Good morning, Mr. Jones. I'm very good, thank you. How are you?
I'm great. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man, still locked in,
Still
but
locked in with the hair.
getting you're in line for the vaccine. If is
I
it
am. I have been considered elderly enough here in Canada, so I'm very pleased that on June 12th I'll be getting stabbed officially. So hopefully it will be okay.
well, that's good. I hope it goes well for you and that you can get back out and do your stuff.
I just want the jiu-jitsu to open, man. I'm so close to just taking the bottle of Lysol that's in the fridge or in the sink and sticking it in and see what happens.
Do you have like a cat or a dog or anything that you attack with jiu-jitsu?
No, no, my 8-year-old is sort of beating me now, so I'm uh, my timing is off.
Yeah,
He did side control the other day and stuck his shoulder in my neck, and I'm like, oh man.
this is gonna be
Uh,
bad when I go back.
I think it's just going to be a slew of carcasses on the floor, and I think I'll be one of them. My body's just not used to it anymore. So
I think a lot of people are gonna feel like that. You probably have good company,
yeah,
gasping for air. So what
yeah, I'm
uh,
gonna love it.
looks like the market's holding up okay.
It's looking very good. The technicals yesterday were looking good. We've been having a great time. Our new subscribers and Alpha Hunters are already sitting on 100% win rate in the last 2 weeks. So things are looking great. The thing that's happening is this rotation is becoming a little bit more pronounced. So as long as you're focusing in the right sectors and you're not, chasing ideas that were great last year. I think we mentioned a couple of weeks ago, lipstick on a pig. It's still a pig. Stop chasing it. There comes a time where the pig needs to be eaten for dinner. And I think that, the stuff that made money last year is definitely not the stuff that's making money this year. So a couple of servings of crow and humble pie are coming out. Eh? That's definite. If you look at some of the superstars of 2020 are definitely the laggards of 2021. So
Do you think that's the COVID, the kind of a response to the COVID, the
yeah, I think there was this exuberance that happened in growth stocks last year, where everyone sort of maybe I don't know, for whatever reason they pumped up the prices of stocks that had, under normal circumstances we'd call them dubious, right? And yeah, I don't like picking on Elon, all right, fellow countryman. Um, but you got to look at Tesla, right? If you look at Tesla prior to it joining the S&P 500, it was a completely different stock. Completely different stock. I think there's definitely an element of people, buying into the man and buying into the company. And I think that there has to be a distinction between the two. Uh, you know, anyone who was buying up on that phenomenal ramp up, let me share the graph. The ramp up here prior to the inclusion in the S&P 500, which was in this period over here, anyone who was getting long at this point did really, really well. But as soon as it was included into the S&P 500, the cultists, I call them, who got in over here, got diluted, because now all of a sudden you had these much bigger institutions that were coming in, and they were demanding a lot more clarity on the business, right? You can't, at this point, I think the P&E, the PE ratio was around 1,000. So you have all these fancy, wealthy fund managers, who get paid to talk about the obvious. This is the funny thing. It's the obvious, right? If you were buying Tesla here, this was an obvious trade. This wasn't particularly difficult, right? Buying Tesla here is not obvious. I mean, 1,000 PE, that's crazy. For a car company that doesn't make profits from cars, that's nuts. You don't need an MBA to work that one out. That was a pretty easy sink. So here, all of this, where you have these fund managers, these high profile fund managers that are doubling down, doubling down, doubling down, doubling down, they have no choice. All right, they've already bought at this level. So by doubling down, you lower your break even, which makes it easier to recover. Now, the problem that you've got is, can it recover? And this is the question that has to be asked, because at a PE of even 100, which it is now, it is still chronically overvalued, still chronically overvalued. So I don't know. I think that you have to eliminate the Elon story from Tesla. I mean, if I was a board member of Tesla, I would be pretty annoyed. Like, this is not value creation in the slightest. And you have to ask yourself about the whole Bitcoin fiasco over the weekend, and all of that stuff. I think that there's definitely a bit of a wake-up call for the Tesla files that we're buying up here. This is a hard pill to swallow, eh? This is not easy. So the market's changing, the dynamics are changing. You look at something like this, which has had a 30 to 40% year-to-date reduction, and you take something like this, where we got in somewhere down here, we got in over here actually, and we've had 3 positions go double on us in the last month. Would you rather be trading for the doubles, or would you rather be sticking to your philosophical similarity with Elon? And I think that this is the hard learn for a lot of retail investors, is this: you've got to divorce your opinion on a personality from what you are actually trading in. When you buy Tesla stock, you're buying a stock of a company that still hasn't made money from selling cars. That's just the bottom line base of it. So it's been good this year. This year so far has been really good. The last couple of months, we've had some really good trades on Google, Amazon, Adobe. We've got the gold trade. We've got a silver trade. We've got some really nice trades on the book. And you've just got to be aware of market cycles. At some point, I have no doubt, at some point, those fancy fund managers that have been doubling down may be right. And I say may because they could still be wrong for a long time. So everything goes in the circles. Just how deep is your pocket? And remember, there was a comment or statement a long time ago by a guy called Jesse Livermore, who was probably one of the most famous traders of all time. And he said, the market can remain irrational far longer than you can remain liquid. And it's such an important lesson. You try and take opinion out of things. The less you can trade on opinion, and the less you can trade on personality. So don't follow someone. Like, I'm a big believer in this. Don't just trade like someone because you like them. You should never do that with your money. That makes you vulnerable to scams and stuff like that. You should trade based on a set of rules, and those rules need to be proved over time. And if those rules are proven over time, then that's what you stick with. Not, oh, I like this guy and he says DODGECOIN is worth so much, so let me go and buy this. It's some of these stories are just crazy.
That's a strange commodity. I don't even really know what it is. I was trying to
It's a joke. It's a complete joke. It's like it was invented for a joke. It was a, here's something that was made in an hour or so. It doesn't take a long time to build a cryptocurrency, and it's worth more than the whole market of silver. Like you have to draw the sort of the conclusion that there's a certain degree of stupidity that sits in the market. And look, as a trader, I sit on one side of a trade, and I always hope and pray that the person on the other side of my trade is a bit more stupid than me. Like, that's the way I trade. I have to try and assume that that's what I'm aiming for. No, a large percentage of the time, the person on the other side of the trade is actually going to be smarter than me. But there's a degree of people, of traders that have come into the market that have got very little idea of what they are doing. And that is dangerous. Like, it is dangerous for themselves. It's dangerous for the people they talk to. I'm a big believer in don't go onto chat boards. I don't follow Wall Street bets or any of that stuff, because it's just dangerous. Like, half of the stuff there is just, it's terrible. You just don't do it.
We've been talking about this a little bit about building positions, and but basically that there's not a bad market. There's just opportunities. When the market drops, people freak out. They see red, they start selling when they really should be looking for places to add or enter trades on these stocks that have sold off.
Yeah.
what is what are your basic kind of guidelines for finding the opportunities in the
Oh, the first thing that you've always got to look at is relative strength, right? So one of the first setups that I look for, give me a second, I'm going to just get the chart up. The first thing that you've got to look for is always going to be your setup in the market, right? You have to identify the sectors that have got strength. So if you look at all of these are all the subsectors, all right? Which ones would you go for? Which charts here would be the ones that you would be most interested in? Well, you want the ones that are moving from the bottom left to the top right. It makes no sense to be doing anything that's falling from top left to bottom right. So, we don't want to trade in markets that are falling. We want to be trading in markets that are moving up. So your markets that are moving up, you've got energy that has been really, really strong over the last couple of months. You've got industrials that are continuing to show strength. You don't want to be sitting around in consumer discretionaries. All right, so you just don't want to be in the areas where there's these red candles underneath these lines. So materials you want to be in. You want to be in finance. You want to be in consumer staples, not the discretionary side, sorry. Healthcare, you've got potential in utilities, potential. All right, utilities may move up again. And obviously, you've got your real estate sector at the bottom. So you've always got to find first the sectors that are moving up. And there are a couple of ways you can do this. The other way you can look at it is if you use a very, very simple tool on stock charts. So shout out to stock charts, where you look at rotation. And it's a pretty simple analysis that you look at. You just choose the sector ETFs. And what you can do is you can just change this to daily, go over a year. Now, my average trading period is around 14 days for a position. So I just move that up to around 14 days. And what you'll see here is over the last 14 days, we've seen a distinct shift in these green ones. So the ones that are green have moved primarily from this blue area into the green box. You had trades that were previously in the yellow box moving into the red box. So your opportunities to start watching for now are going to be in technology, in consumer discretionary, and communication, XLC, right? So these are your three sectors. Now, we've already got a position in XLC because what we believe is that we're going to see stocks move from the lagging sector into the improving sector, and then you take profits in the leading sector. So you want to try and catch it and it's in the red box. You don't want to be in it with the yellow box. Catch it in the red, move it into the blue. So as it's moving into the blue, you're building your position. And then as it hits the green box, you exit the position. You start to take profits. So this is why a lot of people tend to catch these sectors when they're too far gone. The move has already happened. The easy money's already been made. So a lot of people catch these trades at the end of the trade period. They don't catch them at the beginning. So it's an interesting one because when you look at gold,
they're kind of chasing the trade. They see the green and they're trying to just jump in on it. It's too far, too late.
Absolutely. And this is where you've got major issues, because as soon as you start going into the trade when it's too extended, right? So how do we know it's too extended? When you've got a trade that is sitting close to the top end, let me just pull up gold because this one's a little bit easier. So you see this red line here. This is the upper end of the Bollinger Band. When this green candle starts getting towards the top of this band, the price is inevitably going to move back towards these colored waves that we have here. So we want to be in this trade when we make the easy money, right? So this is the easy money trade. This is the hard money trade. This is where most retail guys get in, because once people start talking about the trade, and I've noticed that gold as an idea has been spoken about a lot more frequently in the last couple of days than it has been in the last month or so. You start seeing retail coming in. And this is the whole concept of smart money and dumb money. The smart money gets in early. The smart money looks for breakout signals. So I like to trade breakouts. I like to trade it when the stock has suddenly reversed its trend. It was going down, now it's turned around. And we don't want to give it too long on the turnaround. We want to get in as quickly as possible by the turn. So when we had this double bottom in gold that was formed around the 9th of March and the 31st of March, this was nearly a month between these two. As soon as it did this and it got back into our wave of buying here, it got onto our watch list. We started watching this trade. We waited for the second confirmation of the double bottom. All right, so here is the confirmation over here. And as soon as we had one candle closing above the 8-day moving average, which is this little green candle over here, that was our first buy signal. We got into the trade. And what we did was we just bought one contract, 60 days out, $200. That's all it cost us.
Your little small pilot position.
Totally, just it's small enough for us to put it on the P&L so that we can watch it on a daily basis. So now we've got some money in and we wait. And as the stock starts to move up and you see the 8-day moving average, which is this green band, start to cross over the 13 and the 21 and the 34, and suddenly it starts getting to the top. So the 8-day moving average was at the bottom of the 4. Now it's at the top of the 4. We've got trend on our side. Now we've got momentum. As soon as it crossed to the top side, we add a bit more. That first position is now doubled. We've now added a second position. That second position could be bigger. It could be the same size and dollar value. It's up to your plan to determine what you want to do. But we added some more to it. And we kept adding. As long as we had the confirmation of trend in our favor, we would add on any price day where it came backwards. So if there was a down day in price and the price was still above the 8-day moving average, we added another position. And we just added and added and added. And now what we've got is we've still got this position on. I think this is up about 200%. We've got about 3 different expiries that sit with this, going out 32 up to 64 days. And nearly all of them are double. But you've got to build this. It takes patience. This has been going on since the 8th of April. So every day for a month, we've been sitting and adding. Is there time to add? We'll add another one. And then not only do we do the long calls here, we've been doing debit spreads. We've been adding put spreads. So as these long calls have been appreciating in value, we've been getting paid to capture the momentum going on the upside. Now we have a breakout trade. Our momentum is really improving now, and our price targets are now up here around the 180 mark. These are our exit signals. Once the price gets into this area, we're going to be exiting. So we start taking profits on our put spreads, we start closing off some of our call options, and we start making our money. So our trade will go from here up to this point here, which is this level. That's where we want to be. And that's how you build it. You know, I don't have an opinion on this. I like the gold metal. It looks pretty. We have gold mining stocks as well. We also did positions in Nugget, which is the triple leverage gold miners. We've also got positions in GDX as well. We've got positions in silver as well. I have no opinion on it. Do I care? No, I'm here to make money. I'm not here to enforce an opinion on anything. Whether I like the idea of gold, or they call it a barbaric asset or relic of the past, or whatever they want to call it, makes no difference to me. I just trade it anyway. So
I think
you've got to have that mindset, right? If someone came to me and showed me a setup and you could block the sort of code and you could just take that out, it doesn't really matter what the asset is for me. We just trade that setup. Anything where we have a double bottom with a breakout with the 8 moving above the 13, the 21 and the 34, you have a setup, especially if you've got things like the squeeze telling you that there's going to be compression. Our alpha indicator was indicating upside as well. If you look where that green candle started to form over here, our alpha indicator had gone from below our threshold to above the threshold. That had signaled time to get in. And we stayed in the trade. Even when our alpha signal came down on that little period over here, we stayed in the trade because our green wave was still above the rest. And that's how you do it. You have to have these confirmation things. A lot of people, they don't trade with those sort of signals. So what they're doing is they have opinions. One tweet from Elon, and then that's their signal to do something. And, the one thing that I try and tell my clients is try and avoid trading in sectors or with assets that can be manipulated with one tweet. You know, it's like,
Right.
it's just not worth the aggravation. There are better setups. Honestly, I haven't seen this many opportunities in a while. You know, yesterday alone, I think I looked at 200 different charts. It's hard if you don't have a system by which you can scale and grade, you know, these setups. You're going to fall for everything, you know. So
we're allocated whenever
yeah, you're not going to capitalize on the setup. You know, the thing is, when you've got a good setup, put money in it. You know, I said it last night to my subscribers in a video. It's like every setup starts the same. In my book, everything starts the same. So it's like a race, and everyone gets, let's say, $200 to start with. Let's say, you know, 3 setups on the other side suddenly go from 200 to 400. Graph is still there. Signals are still positive. Macroeconomic environment is promoting that position. It's sort of pushing it forward. Why wouldn't you put more money into it? It's a trade setup worth continuing. Some positions are going to fall off the wayside and die a slow death, and that's okay too. So with what you've got to do is, in your overall plan, is with these good positions, you really have to load them, because those are the ones that are going to pay you for all the losses that you may have incurred on all the crappy positions.
Yeah,
but if everything just stays,
a racetrack, you know, with a racehorse, go to the racetrack and you can keep betting, keep adding money to the one that's ahead.
That's right.
That'd be a great system.
Absolutely. I mean, you know, the thing that a lot of people have is hopium when it comes to a trade. You know, when we set up a trade, you know, the amount of work that went into this trade, you know, managing it and everything, you want to be right. I mean, I don't think I have one client that wants to be wrong. We want to be right. And it is disappointing when things don't work out the way that you hope that they work out. But you've got to be clear to say, you know what? If this 8-day moving average drops below the 13, I'm out. I've got to leave. It means that this trade is not working the way that I wanted it to work, and I'm going to go. So exiting trades is really important. And if you don't have a process by which you can look at a position without your emotions getting the better of you, because your emotions will get the better of you, because you're going to look at a trade and go, nah, I think it's going to work. I hope it's going to work. You know, my buddy at the gym sent me a text telling me to get in, you know, like, I don't want him to be wrong. And he made $1 million on DODGECOIN, so he must be right. You know, we look for these excuses, right? You've got to avoid that. And the only way to do that is to have a very mechanical way of looking at a position. If it doesn't work, you're out. If it's working, you stay in and you give it more time and you give it more money. You keep feeding what's working, and that will create the sort of equity curve that you're looking for.
Yeah, that's a good plan. I don't know why you wouldn't add to a winner and cut a loser. Well, actually, I do know, because it's for me, the exiting the losing trades is
it's the hardest part of the job, honestly, and you know, self-admission here, I'm terrible at it, because no matter what we say in terms of managing your emotions, we are all vulnerable to it. I find that when I put in a lot of work on a trade and I've been working it for months, and it's, you know, it's there, and, you know, my target goal was 100% and it's at 82, you know, like there are days where, you know, I'll look at a graph and it will go, no, it's going to fall. And maybe I just stay in for 2 more days and see if I can get 86%, you know. It affects everyone. I don't know any trader who willfully admits that they're a fantastic exit person on bad trades. It's the one thing that is the biggest weakness of most people. Finding winning trades is not hard. Honestly, I think that that's the easier part of the game. The hardest part of the game is making sure you don't lose when you lose, or don't lose 100% when you're losing.
Right.
You know, that's the hard part. The tough thing with the psychology of trading is fear and greed. We fear losing profit, so we get out too early. We're greedy, we want more, we stay in too long. You know, those are the things that kill people, blows up accounts.
So what do you think about the commodities market? It seems like it's still going up. I mean, it pulled back
Oh,
a bit. There's a lot of pullbacks, but in some of these like
look,
uranium, or,
I think the commodities market is definitely the reflation trade, right? So we know that there's going to be a lot of money printed, and it's happening. What you can see now is definitely a a sort of inflation at the grocery store kind of concept, right? You're going to start seeing prices rise for things like bread and milk, and not necessarily milk, but bread and meat and orange juice and stuff like that. You're going to see it. It's going to happen. Seasonally, we're also in that season where certain commodities tend to do better. You can play commodities in many different ways. You can do it in the futures market. I prefer to use the equity ETFs. So, here's DBC, which is a basket of commodities, strong rise. It's above the 8, trading along the second, this is the 1 Bollinger Band movement. We can see it was extended, price pulled back, it's above the 8. Now's the time to get in. We sent a note to clients to buy shares here, not buying the option. We're buying stock. This is part of our capital trade. So in our capital trade, we focus on areas where there's higher relative strength to the market. So right now, the relative strength sits in Ethereum, it sits in commodities, and it sits in gold. So those are the 3 areas where we are reinvesting our trading gains, right? So commodities, this is the one play on the commodity side. We've got other plays that you can have. So we have a trade also in the Canadian dollar.
I have a question, Chris. On
Yeah.
DBC, you talk about having the shares rather than the options. Well,
Yeah.
what would be the downside of having just a really long dated option?
There isn't any really. The challenge that you've got with a lot of trades is sometimes the options are just too highly priced, number one. And you've always got the risk of theta decay. So what you want to do is, if you see a long-term trend forming, it's sometimes just safer to buy the shares. You pick up 100 shares, you get 100 delta, right? It might cost you a little more, but you have no erosion risk. So you will probably add options to it later, but as a starting position, if you just want to capture that longer trend, sometimes just buying the shares. So we've got the shares in DBC as a potential opportunity for us on the capital side.
That's not a particularly expensive stock either. So
it's not an expensive stock. Yeah. So usually we just try and make it affordable and try and get the best bang for your buck. The other ones that we're doing, which I think are really cool, one of them is SOXL. So this looks horrific, all right? If you wanted to see a bloody slaughter on a stock, this is probably one of the best examples of it, right? Price rising, crash, price rising, crash, price rising, crash. I mean, this is like clockwork, right? So this is the triple leverage ETF on the semiconductors. Now, the one thing that I do believe is that at some point, okay, I don't know when, but at some point, the semiconductor industry will come back to being the leading industry, right? So this is one of the highest growth, fast moving industries. And what we want to capture when you look at SOXL is a rise like that. This is the kind of potential move that can change your account, but you've got to be ready for it, right? So what we're doing now is we're just accumulating stock. We buying, these shares are cheap, right? So every 10 shares is $300. And on days where prices are down, we buy stock. I just buy more and more, right? So at some point, I will reach an allocation of shares from my trading profits. So these are not stocks that are costing me capital. So if I trade and I make $300 of profit, I take the $300 and I buy 10 of these shares. And then I do it again, I buy 10 of these shares. Highly volatile. It's probably not the best investment I've ever made in terms of buying shares. However, A, it's not costing me any capital. B, it's setting it up for that. This is what I'm setting up for. When this move starts, I don't want to be buying it up at the top end of the Bollinger. So I can't watch this every day. So all I do is I just accumulate. And at some point, the squeeze will turn around. This will come around like a smiling face. price is going to rise. Is it going to rise dramatically through the Ichimoku and up to these levels? I don't have a clue. I don't know. But I want to be ready for it when it happens. So I'm accumulating here. Another sector that most of my clients know that I love trading in is biotech. So the other one that I'm accumulating is Labu. At some point, we will get back into that kind of mode where this stock rose from 54 to 185 over 3 months. All right, so that's what I'm looking for. But you've got to be accumulating your position whilst it's in these red zones, because once it starts to move up, it moves up really, really quickly. So again, this is only going to cost $600 for 10 shares. Every time I make 600, I go and buy some more of these shares and I just accumulate.
Labu is leveraged against the XBI.
Yes, yeah, it's 3 times against the biotech index. So, you know, you don't want to be putting too much money in this. You know, at some point, all I really want is 100 shares. You know, if I had $100,000 portfolio that I was trading, I'd only be doing maybe, you know, 50 shares. It's, you know, a 3% position or something. But it's about positioning yourself for what's to come. And at this point, you know, if you're just looking here, you would say it's only going to be red. Well, at some point that red turns to yellow and then it turns to green. And that's what I want to be in for, right? And that's when I start using the options. So there's that one. But back to commodities, you know, the other trade worth looking at is the Canadian dollar. All right. So if you look at what's been happening with the Canadian dollar since, let's have a look, since, when's it, September? You know, since September, we've had quite a strong rise in the Canadian dollar. This trend is very, very clear. Bottom left, top right, trading above the 8-day moving average, bit of a pullback. So, you know, commodity dollars, so Aussie dollar, Canadian dollar, New Zealand dollar, those are the ones that you probably want to be in from a currency perspective. So you can play the strength in the Canadian dollar pretty much either through FXC, or you could play it through the Canada ETF. You know, if you look at this from October last year, this has been quite a rise. From October, we were trading at 26 up to 37. You know, it's done fairly well. So that's the commodity space. We've just started a new position in corn. So we got back into the corn trade. We traded it up here. I don't know if you'll remember, but we got out, I think it was beginning of May. We got out, I think, around here. We could see that the trade was getting very extended. You know, when you see these things going virtually parabolic, you know, these kinds of pullbacks allow you an opportunity to get back in. So yesterday we got back in to a corn trade. Here it is back on the 34 moving average. And now we're starting to rebuild the trade. And I think that this will go back up again, probably up to the 24 level. So, you know, back to corn, you know, anything corn. You can look at beef or cattle through great name on the stock, Moo. You know, you can play, you've got wheat as well.
I have 2 positions or 3 on uranium right now.
Yeah, well, this one is, you know what, this is probably, if I had to say, the one trade, I had to go back 11 years on data to look at this one. But URA, let me get this back to 2011. Let me set this up. So time interval 20 years. Okay, have a look at this. So it's a pretty fascinating graph. So if we just, I mean, look, it's probably completely meaningless in terms of time, but let's just play this. Look at this. If you go back to where uranium was, look at that. So it was up at $134 a share. This, I think, is 2004, right? So if we draw a simple Fibonacci, so, you know, just doing a simple Fibonacci here. I mean, I'm not going to go into lot of detail on it, but if I just draw a simple Fibonacci from there, and I go all the way down to its low, where is it? So yeah, it's low there. Okay, look at what the retracement prices are forecasted at. Now, see how this price is like exploded from here.
Mm-hmm.
So we can see in the short term, my next Fibonacci level is up at 37. So this to me looks like an interesting longer term play. You know, I don't think it's going to get there in one day, but in terms of trend recovery, for 7 or 8 years, this has done nothing. It's done absolutely nothing. And yet in the last couple of months, we've seen it go from, you know, under 11, it's doubled. You know, this is a sector worth having a look at. So we've taken some positions in uranium for the long haul. I think that we've got potential to be taking profits along the way as well. You know, maybe buying some stock. I might be picking up some stock later on as part of the commodity play into it as well. But silver and gold remain our big positions. One of our gold holdings yesterday did really well. Victoria Gold yesterday, massive move yesterday. Look at that for a move right up to the top. That was a move of from 11 to 14 for yesterday. So, you know, here we're expecting price targets around $16 for this one. Very, very strong signals on our Alpha Hunter score. Squeeze starting to fire to the upside. You know, this is a pretty interesting one to watch. So, you know, I'm very bullish on gold and silver. The other play was nickel. You know, looking at the nickel markets, you know, you have this issue with electric cars and their batteries. And lithium is a main component of the batteries, but nickel is also pretty valuable. And you can play nickel in two ways. You can play it either through Vale, which is the world's largest nickel producer. But this stock was very extended. You know, you can see, let me just change the date again. Yeah, you know, it's going back 20 years every time. Let me change that to just 1 year. So Vale, let me just make it 6 months. Vale was very extended here. So might be actually attractive here on this pullback. So the choice that we had was we can either play Vale as a trade, or you can play the Latin American ETF called ILF, of which Vale is a big percentage of this trade. So we decided to go with the ETF rather, because this trade scored about 120 points, and it's above our limit, whereas with Vale, it's below our 70 threshold. So the signals are a little stronger on ILF, and we're going to be playing this as part of the nickel trade on electric vehicles for the production of batteries. So there's a lot of opportunities. I think that the opportunities in sectors like energy, just energy by itself. You know, we put in a bull put spread yesterday on energy. We did the 53.51 bull put spread yesterday, slightly out of the money. Slightly in the money when we did the trade, and we got the price movement to the upside. If we can get, you know, if XLE can open up a little bit higher than 55, if it can get above the 55 level today, we may be able to take profits on our bull put spread pretty quickly. And that was originally set up for a month. We've also got trades in Citibank. Our Citibank trade is up nearly 80% since we got in. We got in over here on our alpha score when it was at around 100. Now it's up at about 120. So this trade has done really well. We've got a trade on in FedEx. We've literally gone into the sectors that have got strength. And then what we do is we look for the stocks that have got the highest relative strength in those sectors. And where the stocks are vulnerable, so maybe the chart patterns are not in our favor, we will just go with the ETF. So at this point, XME looks very attractive. XLI looks very attractive.
Yeah, I had a couple of trades on XME, made some pretty decent money, and then just kind of waiting.
XLE, yeah, XLE,
XME.
yeah, this one, as soon as it gets above,
I've got positions on this one right now, but I had XME. I had some.
Oh, XME, yeah, XME is a good one. Now, XME is a nice trade. This pullback was really good. It pulled us back to the 21, and now look at that reversion, right? It just pulled back and bounced straight up again. If we can get above the 47.23, 47.23 gives us a breakout with a price possibility of 49, which is nice. Now, XME is great, but what's even better is our trade that we did in Newmont. So we've got a couple of trades in Newmont mining that have both gone up 100%. Wait, let me open up the trade. So NEM. Yeah, so both of these trades on NEM are up 100% that we've done. One is for September and the other one was for January. And then on gold, here you can see our three positions that are all up 100% as well. So, the thing with the trading, you've just got to have a plan. Like, I think that 95% of all your trading worries disappear when you've actually thought things through, as opposed to just randomly reacting when the market's open. It's like this mad scurry. I always think that people are like squirrels, and you can see it in the first hour of trading when you look at the volume numbers and the volatility, and it's all over the place. And, you just avoid that. Like, I don't try and trade in the first hour of the day.
You get everything's bouncing around. I just like to wait for it to calm down a little bit before I place the trades.
Sometimes if you've got an idea of where you want to trade, where you want to go into a trade, then wait for the first hour and see where the stock is trading, and then you can actually do something constructive. But trying to get it on off the bat, I think it's a fool's game. You're playing in unrealistic markets. It's not real at that point. The first hour of the day it's not the real market. You want to trade just before lunch.
Algo buying and selling in the first.
Yeah, and it's people putting in orders the night before, and everyone stops getting nailed, and it's just, sometimes you just got to go. That's why you got to do jiu-jitsu in the morning. Or jiu-jitsu at lunch. I used to be a big lunch fan. Between 12 and 2, you sort of just go and train, and then you come back and do
a lot going on in the market 12 to 2. It's kind of,
yeah, it's dead. There's nothing better than a Friday, though, when you see all these guys come back from lunch and they're all a little bit drunk, and then you can see their drunk trades coming out somewhere at around 2:30 on a Friday before a long weekend. That's pretty exciting to watch. It's like, what the hell is this guy doing? He's buying the wrong stuff. Okay, you can trade on that. But it's an interesting time to be trading. Everything comes down to your plan and how you manage your brain. It's not about how big your account is. It sounds really cool. When you hear of people making these millions on GameStop and millions on this, but sometimes those people were lucky, because I don't think they realized the risk they were taking. And we never hear the story of the guy who mortgaged his house and lost everything. That doesn't make the news. So, for every person that's made millions, I'm sure that there are maybe 10 to 20 people who've lost everything. So it's a game you've got to be exceptionally careful with. And that's why position sizing and strategy are the winning tickets. If you've got a position size rule, where you're going to enter, why you're entering, and when you're going to exit, you've pretty much covered all your bases. You don't run the risk of, your buddy telling you to do something and then you overload and lose, and, you just don't want that.
Yeah.
You can trade aggravation free. It's really, really possible. But you've got to have a plan.
Definitely. It definitely helps. I can speak from experience of the not the experience you have, but my experience. But Chris, I enjoyed talking to you this morning, and we've got, I know you've got your alpha hunters. You go to Rogue Investing /alpha and do with the paycheck trade service, and you're doing another webinar tonight called Crash Proof about protecting your portfolio in down markets. So guys, go over there and check that out. I mean, Chris has pretty much 100% win rate with the trades that he sent out so far. So you don't want to miss out on that stuff. But I really appreciate your insight as always. Good chatting with you.
It's a pleasure. I look for maybe, maybe I'm going to grow a haircut, a different hairstyle when I get the vaccine. Like, I don't know.
There you go. Get your vaccine haircut. You've had the COVID haircut, and then you go for the
Man, don't tempt me. I am so keen to just go shave the whole lot off. And
I dare you.
I can't. My head is a bit weird. Like the shape is a little off. It's from years from being hit on the head with a pan. I've got a bit of a dent at the back. But it's great to talk to you again, Brian. I'll see you later. And guys, rogueinvesting.com /alpha. Join me later on, and we can have a chat around crash proofing your portfolios.
All right, guys, and Chris, take care.
Take care, man. See you later. Bye.